So what is investment appraisal? Investment appraisal is the process of evaluating potential capital projects to determine whether they are worth pursuing by estimating expected cash flow and assessing profitability using metrics such as NPV, IRR, and payback, while considering the cost of capital, risk, and strategic fit to guide smart, value-maximizing capital allocation.
Okay, now we will look at case study of Zain Life Sdn Bhd. They have a machine that have depreciation of 8,000 and accumulated depreciation of 40,000, which we can get loss on disposal of 9,000. Also, they want to replace the old machine, right? So we have new machine. New machine, the depreciable amount of new machine is 70,000 after we deduct service value, and 70,000 we will divide it by 5 to get the depreciation, which is 14,000, and will resulting at increase in depreciation for the Zain Life Sdn Bhd, which is 6,000. And then we can look at initial outlay. Initial outlay is initial investment that happened at year 0. So we will add cash outflow but minus cash inflow, and the initial outlay that we get is 111,840. Now we can look at annual cash flow and terminal cash flow. Annual cash flow is cash flow that company will get from year to year until the project ends. For the calculation, we will add benefit minus cost minus depreciation minus tax, but we will add back depreciation because depreciation is uncash expenses. So we will get annual cash flow of 30016. Now we're going to look at terminal cash flow. Terminal cash flow is cash flow that happen when the project is end. So for the calculation of terminal cash flow, we will add final service value minus material, but we will add account payable. So we will get 75,000 for the terminal cash flow.
In this case, we have the same amount of cash flow every year. The payback period can be calculated by taking the initial outlay 111,840 divided by the annual cash flow 30016, resulting to 3.73 years. Next, based on the question, to calculate the NPV of the capital budgeting proposal, the life of the project is 5 years with the cost of capital of the firm is 10%. The amount needed to calculate NPV is initial outlay 111,840, annual differential cash flow 30016, and terminal cash flow 75,000. The NPV amount will be obtained by multiplying the cash flows value by the rate based on PVIF and PVIFA tables. 48512.50 cents is the outcome of the calculation of NPV. IRR method is used to determine the rate of return on an investment or a project. This method is alternative to NPV. In this method, we would like to determine the return where NPV equals to 0. If I equal to 10%, then it shows that the NPV is positive. However, if the return is higher than 10%, we may need to choose a higher discount rate. The project's IRR will be between 10% and 24% if the NPV is 24% negative. Calculation for the IRR will be as follows. The initial outlay was 48512.50 cents with a 10% NPV. between 10% and 24%, there is a difference of PV of 52363.72 cents. There's a 14% gap. Therefore, the result from the calculation is IRR equal to 22.97%.
From our analysis, Zen Life Syndrome Height should replace the old machine because NPV is positive, payback period is less than target period, which is 4 years, but ARR is higher than cost of capital, which is 10%.
So, what is SME? Small and medium enterprise or SMEs refer to businesses that operate on a smaller scale compared to large corporations. These businesses usually have limited capital, fewer employees, and a smaller business operations, and they are commonly owned and managed by individuals or families. Even though SMEs are smaller in size, they play an important role in the economy by providing employment, supporting local communities, and contributing to economic growth. Therefore, SMEs are considered an important sector in many countries.
Hi, my name is Nur Dennis, and we will be discussing the issue of the article of financial management strategy and discussing the strategy. The first issue is main issue, which is getting capital to support operation and expansion ambition. Small firm does not have easy access to traditional finance sources like bank loans, particularly if they have little collateral experience, but they could prevent this by investing in new sources of funding, such as crowdfunding, angel investing, or venture capital. Next, we move to the second issue, which is capital budgeting. Capital budgeting is also a common issue that may face in SME, as it may affect the financial decision making. Hence, SME must carefully assess investments such as building new facility, introducing new product or technology to achieve possible return on investment. SME also need to consider comprehensive financial analysis, including variables like market circumstance, competition, and risk, so that they can decide the best project to take while using their limited resources. The third issue is about utilizing financial tools and software for business efficiency. Recently, many businesses use tools and software to stay competitive and increase productivity. The useful software like accounting system, budgeting tools, and analytical platform is useful for simplifying their financial procedure, obtain insightful knowledge of their financial performance, and make defensible decisions based on up-to-date data. Next issue is risk management and mitigation for SME. To secure their long-term viability and profitability, small and medium-sized business must implement risk management and mitigation procedure, which is by diversifying their clientele and revenue stream. They need to grow their clientele and range of product, and also reduce risks by recognizing potential risks such as financial, operational, and market risks. The last issue is about effective cash flow management and small enterprises. Cash flow is important as it ensures the business has enough cash on hand to cover its day-to-day expenses like rent, utility, and payroll. Thus, if the ineffective cash flow happens, the small and medium-sized business must keep a careful eye on their cash flow, optimize their payment procedure, pay for advantageous terms from supplier, and allocate emergency reserve for unforeseen costs. That is all for the issue of the article. We're going to see the next part of the video.
Assalamualaikum. My name is Nur Angisina binti Muhammad Anizi. Next, I would like to present to you about the investment appraisal process. SME face several challenges in conducting effective investment appraisal due to their financial and structural limitation. The first one is limited access to finance. In the article, it highlights that SMEs often struggle to obtain external financing from the banks due to the lack of collateral and credit history. This limits their ability to appraise and undertake profitable investment projects. Second is cash flow constraint. SMEs frequently experience unstable cash flows. This makes it difficult to accurately forecast future cash inflow, which is essential for proper investment, appraisal, and capital budgeting decision. The third is high financial and from market risk. SME operate in uncertain and competitive environment. The article emphasized that market volatility and operational risk make investment outcomes uncertain, complicating the appraisal process of the SME. The last one is difficulty in long-term planning. Due to short-term survival pressure, SME may focus more on intermediate liquidity rather than long-term value creation. This limits the effectiveness in long-term investment appraisal. It is important to overcome the challenges in investment appraisal because these challenges can directly affect the survival, profitability, and the growth of the SME. So, there are two methods that can make to do a investment decision. The first one is net present value. Net present value measure the profitability of the investment by comparing the present value of future cash inflow with the initial investment. The second one is payback period. Payback periods measure how long it takes to recover the initial investment. The important part that we must know is we accept the project if the NPV is positive. Meanwhile, we accept the project if the payback period is shorter than the target period. Next is decision-making techniques. There are two techniques that can we use, which is NPV and PP. The first technique we use is net present value. Net present value, also known as the most reliable method. NPV important because it helps the management to decide whether an investment will add value to the business in a long-term decision. It also considers the time value of money, making it a reliable decision-making tool. The next one is payback period. This technique is simple to use because it ignores time value of money compared to NPV. It helps SME management cash flow to constrain and risk. Payback period also focus on liquidity and risk that the company may face in accept or reject the project. It also preferred by the businesses that want quick return.
In conclusion, small and medium enterprise face various challenges, especially in managing their finances effectively. Based on the articles selected by our group, issues such as poor cash flow management, lack of financial planning, and limited access to financing can affect SME performance. By applying proper financial management strategies, SMEs can improve their business sustainability. In summary, effective financial management is very important to help SMEs survive and grow in the long term.